Hey friends! In the past few weeks, my inbox has been flooded with one question. What's going on with stablecoins? And for good reason. In just the past few months, we've seen the US Senate passing the key procedural vote for the Stablecoin Genius Act, Hong Kong approving its own stablecoin bill, the EU, Singapore, the UK, South Korea, all rolling out stablecoin regulatory drafts this year. Even Pan Gongsheng, governor of the People's Bank of China, publicly talking about stablecoins for the first time. On the market side, Circle, the first stablecoin company to go public, saw its stock price jump 750% in under a month. The Trump family? They've launched their own stablecoins. And payment giants like PayPal, Stripe, JP Morgan, Citi, Goldman Sachs, even JD.com, Ant Group, and Xiaomi have all jumped in. So, is this just hype? A money grab? Some US conspiracy? Well, if so, why are so many governments and corporations diving in at the same time? Let's unpack what's really going on and take a full tour of the stablecoin battlefield. Section 1. What is a stablecoin? A stablecoin is a type of cryptocurrency, like Bitcoin or Ethereum, but with one big difference: it's stable. Most are pegged 1-to-1 to the US dollar. The largest? Tether, USDT, issued by Tether Limited. Here's how it works. You give Tether $1 and they give you 1 USDT on the blockchain. That coin can then be used for payments, trading, or investing, and it can move freely across multiple blockchains. Why is it stable at $1? Because you can always redeem it from Tether for $1 and there's no limit on supply. If market price goes above $1, traders mint new coins and sell. If it drops below $1, they buy cheap coins and redeem them. That automatic arbitrage keeps it pegged. And every coin is backed by real assets, mostly US dollars or equivalents. Example: in Q1, Tether had 143.68 billion USDT in circulation, backed by 149.227 billion in reserves, an extra $5.6 billion cushion. Think of it like a gaming company issuing tokens or credits, but with real-world collateral. The second biggest stablecoin, USDC, issued by Circle, about 24% market share. Section 2. Why are stablecoin companies so profitable? Tether made $13 billion in profit last year, with just over 100 employees. That's over 100 million profit per person. How? When you buy stablecoins, they take your dollar and invest it, mostly in ultra-safe short-term US Treasury bills. At today's high interest rates, that's a gold mine. Example: 100 DB members in reserves at 4% equals to 6 per year in interest. Circle also earns big from interest, but shares a chunk with crypto exchanges, who then pass incentives to users. It's a bit like credit card rewards, a cycle of incentives to keep users hooked. Section 3. Why do people use stablecoins? 3 key reasons: fast and AMP, cheap cross-border payments, bank remittances for small currencies, 5% plus fees, days to process. Stablecoins, minutes, minimal fees, no SWIFT, no bank middleman. Privacy. Like in-game currency, you might know the sender's username but not their real identity. Though every transaction is still visible on the blockchain ledger. Stability: unlike Bitcoin, value doesn't swing wildly. Perfect for commerce, savings, or payments in volatile economies. Section 4. Where they're used most: underground black markets. Previously Bitcoin's domain, now moving to stablecoins for price stability. Cross-border payments, now 50B month, growing 20-30% monthly. The global payments market is 200 trillion year, so there's massive headroom. High inflation countries: Argentina, Nigeria, Brazil, Turkey. People use stablecoins as digital dollars to escape currency collapse. Some governments tried banning them, then flipped to supporting them when public demand was too strong. Brazil's payment system Pix now connects with stablecoins. In Argentina, you can legally pay rent with them. Section 5, the risks used in money laundering and speculation. Peg failures and frauds have happened. Lack of clear regulations keeps big corporations cautious. Which is why the recent wave of legislation is such a big deal. It's not just about restrictions, it's about legitimizing the market. Section 6, U.S. Genius Act, and Trump's role. Trump's administration is openly pro-crypto. He even launched his own coins, both speculative and a USD-pegged stablecoin called USD1. When Abu Dhabi's sovereign wealth fund invested 2B, USD1's market cap jumped to 2.2B. The Genius Act, a 20-30-page bill, sets rules for who can issue stablecoins, must be licensed. 100% reserves in safe assets like short-term treasuries. Strict disclosure, risk management, anti-money laundering. Essentially, bringing stablecoins under bank-level regulation, but with even stricter reserve rules. Section 7. Why the U.S. is pushing this. Strengthen the U.S. dollar's global role. 99% of stablecoins are USD-pegged. Wider use means deeper dollarization abroad. Boost demand for U.S. treasuries. Reserves are largely short-term treasuries. Scaling up stablecoins yields more treasury buyers. Dominate the crypto space. Instead of fighting crypto, embrace it. Legislate first, and set global standards. Section 8. Other countries' approaches. Proactive and AMP. Open. Singapore, Hong Kong, UAE. Cautious and AMP. Restrictive. EU, South Korea. Bans or heavy limits. Mainland China, Bangladesh, Afghanistan. Hong Kong, for example, is piloting HKD and offshore RMB stablecoins under a sandbox model, with big players like JD.com, Xiaomi, Standard Chartered, and soon, Ant Group. Section 9. Beyond stablecoins, tokenization and AMP, RWA. Stablecoins are just one type of real-world asset, RWA, putting real assets on the blockchain. Houses, bonds, intellectual property, even infrastructure projects. BlackRock has already launched a 2.9B tokenized US dollar money market fund, BUIDL, where investors earn yield in stablecoins. Ant Group in China is exploring tokenized assets like EV charging stations and solar power plants in Hong Kong's regulatory sandbox. Closing. So, stablecoins aren't just crypto hype. They're at the intersection of payment systems, global finance, and geopolitical currency wars. Governments see them as tools to extend influence. Corporations see them as profit machines. And everyday people? They just want a currency that's fast, cheap, private, and stable. The race has already begun, and the rules are being written right now. The question is, who will control the future of money?